Well, my name is Darren Wagner. I'm the founder and CEO of DragonCharts and also Morpheus Trading Group. For those of you who are not aware of Morpheus Trading Group, that's my company in the US that I started about 10 years ago. And if you look at the website, which I'll type the address here, you can see on our website we have something called Performance. There's a tab that's called Performance. And that Performance tab actually shows you the history of and the track record of our trading strategy. What we have is a proven trading strategy that we've been teaching to thousands of traders over the past 10 years, and we're now teaching that strategy to traders around the world through DragonCharts. And in today's webinar, what we're going to be doing is providing you with an overview of the strategy that we've been teaching people. Now, obviously, in the course of a 30 or 45-minute webinar, there's no way possible that I could teach you the entire trading strategy or methodology. But what I will do is give you an overview of what we do. And of course, our traders who become our clients do get much more hand-holding. They get the entire video course, and they get daily videos, and they can also get newsletters and through Morpheus Trading and so forth. So there's a lot more involved, but we're going to at least give you an overview. Now, DragonCharts basically consists of two things. One is education, and one is the tools, which is the software. Now, the education is an entire video course that we provide traders that goes into detail of our trading strategy. As I mentioned today, we're going to go over just a brief overview of the strategy. And then we also have daily videos in which we demonstrate our strategy on a continual basis. People learn our trading strategy, and that's included with your subscription. And then we have a software, which is actually a stock scanner. And what a stock scanner does is it enables you to narrow down the list of all the stocks in your stock market to find the best candidates that match the criteria. And our stock scanner is designed to work hand in hand with our proven trading strategy. Joining me today, I also have Ed Baylog. Ed is actually one of the traders at Morpheus Trading Group. And so Ed's going to be taking over and talking about near the end of the presentation about money management and the psychology of trading. That's kind of his expertise. So I'll start things off, and then we'll pass things over to Ed a little bit later on. Okay, let's first of all talk about the main strategy types for investors. There's several different ways that somebody can invest in the stock market. First is traditional buy and hold. And many people are familiar with this. This is simply buying a stock and holding it for 1 year or longer, 1 year, 5 years, 10 years, even 20 years. The benefit of that is it's pretty simple. There's not a lot to do. You pick a stock and you buy it. The downside is that there's not a lot of control you have. If the market goes down, your stock's probably going to go down. Another type of trading that's out there is called position trading. Position trading is when someone looks to hold a stock at least maybe 1 month, 1 month to 6 months on average, looking to take advantage of strong momentum in the market. The advantage is big gains can be had, but there again, it's really related to trend. And the other thing with position trading is it can be very volatile. Big swings in your portfolio can happen through position trading. Another type of trading is called swing trading. This is what we do. And swing trading is a shorter term time frame where basically people look to hold stocks anywhere from several days to several weeks. And the benefit is you have a lot of control over what happens in the market because you can trade on both sides of the market very easily. You can buy or you can sell short, which means you make money when stocks go down. The other benefit of swing trading is that you can clearly define your risk ahead of time by setting your stops, and it can be very clearly defined. Perhaps the only downside is that it does involve a little bit more active management than, say, position trading or long-term holds where you just buy a stock and sit with it. And then, of course, the next type of trading is day trading, which is exactly what it says. That's when someone buys and sells a stock all on the same day. And the benefit of that is it's relatively low risk if you honor your stops because there's no risk of overnight news. So the volatility can be very low with day trading. The downside is you have to be in front of your computer all day, every day in order to do it. So as I mentioned, what we do is swing trading, which falls right in the middle there. We swing trade with what's called a near to intermediate term time frame. So we're not day traders, but we don't just buy and hold stocks either. We do what's called swing trading. We trade with what's called the intermediate term trend. That means the market's either trending higher, or it's trending lower, or it's going sideways. At all times, the market will be doing one of those three things. And by intermediate term, what we look for is the trend of the market over the past several months. Is it going up or down or sideways? And I'm going to show you some charts that demonstrate this. The other core belief of what we do at DragonCharts is that momentum-based strategies work. We trade with momentum of the stock market. And momentum works because an object in motion tends to stay in motion. If water is running down the side of a mountain, for example, it's going to continue going down the side of that mountain until it reaches the bottom of the mountain. Even if something is in its way, it's going to flow around it and the momentum will continue. Well, it's kind of the same with stocks. When stocks are moving higher, they generally will continue higher for a long time until something finally causes the trend to reverse. Likewise, if stocks are trending lower, they generally stay lower until something causes it to reverse. So that's one of, I believe it's Newton's laws of physics. An object in motion tends to stay in motion. Stocks trading near 52-week highs have the least amount of overhead resistance. Contrary to popular belief, when a stock is trading at its highest price of the past year, the past 52 weeks, those are some of the best stocks to buy because there's nobody that's trying to sell those stocks when they move higher because people didn't buy at a higher price and they're looking to get out at break even. They just want to stay in the stock because it's moving higher. So part of our strategy is we look to buy stocks that are at new highs. Conversely, stocks that are cheap for a reason. We don't like to buy cheap stocks because cheap stocks generally continue lower, and they're cheap for a reason. They're cheap because no one's buying them. So we don't buy them and hope that something's suddenly going to reverse. So here's the key. We buy high and we look to sell higher. We do not buy low and look to sell high. Traditional wisdom on Wall Street and in markets around the world is that the best strategy is to buy low and sell high. But we don't believe in that because when you buy low, generally that stock will stay low. We buy stocks that are priced high, but we look to sell higher. Human nature is to underestimate how long a trend can last. It's difficult to understand sometimes how strong momentum can be, but I'm going to show you some charts here that'll kind of open up your eyes. Risk control is everything. It's extremely important to have clearly defined risk on every trade, making sure that when you're right, you stay in the trade, but when you're wrong, you get out of the trade very quickly. We're not right on every trade. In fact, we're only right on about 60% of our trades. But the reason that we're profitable over the long term is because when we're wrong, we get out very quickly, and the risk is clearly defined ahead of time. So Ed's going to be talking more about that with you a little bit later on. We define our risk up front with every trade. And the main market structure is we look for a base to form in the stock, and then a breakout, and then a pullback. Now here's the fun part. Let's dive into looking at a bunch of charts. This chart here is simply an example of what we call trading with the trend. I mentioned earlier that we trade with the dominant trend of the market. Now, first of all, the examples that we're using here are for the U.S. stock market. But as you know, DragonCharts covers many markets around the world and specifically Asia. And the strategies that we teach work the same in every market around the world because human emotions and psychology of trading is the same around the world. So even though we're using examples for the U.S. market, doesn't matter whether you trade in Malaysia or Singapore or India, Hong Kong, it doesn't matter. The strategies all work the same. So in this particular case, you're looking at a chart. The bottom is called the S&P 500. That's simply a broad market index, such as, for example, the Nifty index in India. On the top is the stock. So notice how when the market is trending higher, this is an intermediate term uptrend, we're looking to buy stocks. Now, if the intermediate term trend of the market was down and the market was trending lower, then we'd look to sell short stocks that are moving down. So quite simply, we trade in the direction of the dominant market trend. I told you earlier that momentum-based strategies work. Remember, I said we like to buy high and sell higher because an object in motion tends to stay in motion. Here in this particular chart, notice that a strong uptrend begins the move off the lows. So we have an uptrend take place. This is a weekly chart. So each one of these bars you see is 1 week of price action. So you're looking at 3 years of prices here. So notice that we don't try to catch the bottom. Excuse me. We never try to catch the bottom and figure out where this uptrend is going to begin. However, once the uptrend begins, all right, from off the lows here, we've already got a 300% gain at this level right here. So this is the point now actually where we look to buy stocks is once they've actually formed that initial base and they have an uptrend in place, even though it's up 300%, this is where we actually look to start to buy once the uptrend develops. And notice how after the 300% gain, it formed a 60% gain within several months, and then a 36% gain, and then a 20% gain. So this is basically what we do with swing trading is we look for these bases to develop and then the next breakout to happen. Base to develop, breakout, base, breakout. And we look to catch these moves. We look to capture on average about a 20% gain on each move before we look to sell into strength. Sometimes we make more, but that's what we look to make on average. Here's another example. Notice again, this is a different stock, but notice how the uptrend begins off the lows, 230% gain off the lows. Then we get a 70% gain from there. A base forms, a 40% gain, a base forms, and then a 20% gain. One more example. Strong move off the lows, 280% gain, a base forms for several months, then a 75% gain, base forms for several months, a 40% gain, a base forms, and then 35% gain. This proves what I was telling you earlier, that an object in motion tends to stay in motion. When there's strong momentum behind a stock, that trend will continue for much longer than what human nature would expect. With our strategy, we don't look to buy down here at the lows. We don't look to capture the bottom because we don't know where the bottom is until it's already moved. We wait for the breakout to develop over the course of several months, like you see here, then the base, and then we look to capture the meat of the move out in the middle. We're not looking to catch the bottom, or we're not looking to sell at the top. We look to catch these moves in between. I mentioned that another part of our strategy is we buy stocks that are at or near 52-week highs. Here's a good example of how stocks at 52-week highs are strong. This is a monthly chart, so each bar you see here is actually 1 month of price action. Okay, so this is a several years you're looking at here. In this particular example, notice how right here, when the stock breaks out above its prior 52-week high, okay, its highest price of the year, notice how until that level, the stock just kind of drifted around. But once it broke out above that prior high, it shot straight higher. In fact, it went higher about, looks like 10 out of 11 months in a row it went higher. And it was 170% gain over the next 11 months, around 170%, because when stocks are at new highs, there's no overhead resistance. Here's another example. This stock breaks out of a long 18-month base of support, breaks out to a new 52-week high, and goes on to rally 700% over the next 2 years. Okay, now that's a 2-year period, of course, but still a 700% gain over a 2-year period because the stock was at a new high. And here again, look, notice how every time the stock goes to a new high, it surges higher. This is why we don't buy stocks at lows. Remember I said we look to buy stocks that are high and sell them higher. We buy stocks that are strong. In this particular example, this shows why we don't buy stocks that are at their lows. Now, human nature and human psychology is to buy stocks at their lows and hope that they will reverse. But that completely goes against our methodology, and we don't believe it works very well most of the time. In this particular case, notice how UNG, it doesn't matter what the stock is. As I mentioned, this strategy works the same in all markets around the world. But in this particular case, notice how the stock dropped a whopping 50% off its highs, okay, and came down to, but you could call it support of its prior lows, this horizontal support. Now, if someone likes to do what's called bargain hunting, they might say, oh, this is a good bargain right at this price because it's down at the lowest price it's been for the past year. However, look what happens. This horizontal line right here, this is the $65 level that we showed you in the last chart. If you bought here and you thought it was a good price, well, it went on to sell off another 70% after that. So now that $65 buying opportunity, when the stock came from 130 down to 65, that didn't look like such a good deal when the stock is down to $18 now. So this is a good example, and many charts look like this. When a stock is too far off the high, it continues lower, because once the momentum is in place, it continues lower. Well, check this out. You think $18 is a good deal? It can't go any lower? Notice how the following year, the stock dropped down to $10. Is this the low? Who knows? Nothing to say a stock can't go to zero. But the big point here is that when a stock is trending lower, it generally continues lower. We don't look to buy stocks that are weak. We don't look to do bargain hunting either. We buy stocks that are strong, simply going with the trend. In fact, a stock like this is something we would look to sell short and profit when a stock is moving lower. The proper way to invest and to trade is with the momentum of the trend. And this chart here kind of summarizes our swing trading strategy. The stock breaks out to new highs, forms a base, and breaks out. Every time the stock forms a base, by base I mean when the price trades sideways. Okay, notice how it trades sideways, and it does that for at least 2 to 5 weeks. This is a buying opportunity every time the stock trades sideways and then moves above that high. Buy point here, a buy point here, a buy point here, a buy point here, and a buy point here. These are all valid breakouts of bases, and this is what we teach in our detailed newsletters for Morpheus Trading, and also in our video courses and our daily stock pick courses. And this is what our software is designed to find: is stocks that are forming a sideways base and then that can have the potential to break out to new highs. Risk control is also everything. We always trade with stops. I mean, in this particular case here, we have a valid breakout entry when the stock moves above this high, but not every trade works out. In fact, many trades do not. So every time we enter a stock, we have a stop in place as soon as we enter it, so that if the stock breaks out, moves higher, and comes back down, once it breaks below support, which is this prior low, then we're already out of the trade. We're out right here. So our loss is very limited, generally no more than 7 or 8%. If you don't honor your stop, look what happens. The stock continues lower and you drops another 20%. Here again, we have an entry, a buy entry on the breakout of this downtrend line. As soon as we enter though, our stop goes into place right below the prior low. And on this day right here, when the stock breaks down and fails to move higher, we're out. No questions asked. So we always place our order so that we know we know when to get out ahead of time as soon as we get in the stock. Just to summarize, there's 5 steps to becoming a master trader. The first step is to identify the trend. We use daily and weekly charts for that. Second step is to identify proper trade setups. Third step is to have a clearly defined exit strategy. Fourth step, have a disciplined money management strategy. And the fifth step is understand the psychology of trading. So this is the 5 steps that we teach in order to become a master trader of the stock market. This is what's necessary. The first step is to identify the trend. We use technical analysis to do this, but we keep it very simple. We generally use moving averages. We use what's called a 20-day moving average, which is this dotted line you see here. We use a 50-day moving average, which is a teal colored line, the blue line. And we use a 200-day moving average, this orange line. For an uptrend to be established, we need to see the 20, the 50, and the 200-day moving averages all sloping higher. And the 50-day moving average must be above the 200-day moving average. And the 200-day moving average must be trending higher for several months. In this particular case, notice that we do not have an uptrend established yet because it's too early. We've got the 20-day, the 50-day, and the 200-day all sloping lower. Now here we have the 50-day moving average and the 20-day crosses up above the 200-day moving average. However, the 200-day moving average is still in a downtrend, so it's too early. So we look for that trend to be established first. Now in this case, now the 200-day moving average turns higher, and it's higher for several months. Once we have this happening, the 20, the 50, the 200 are all trending higher. That's the first step to identify that the stock is in an uptrend. And once it's in an uptrend, we wait for the first tight base to form, which right here with the weekly chart, you can see this is a base, the sideways price action. And then our buy entry is on the breakout above the high of this base. Step 2 is identifying proper trade setups. Take a look here, looking at that chart a little bit closer up. Here's what's called a base. A base is formed when a stock consolidates. That means trades sideways for a few months, and it's anywhere from 15 to 30% off its high. So this is the high point here, and this pullback should be no more than 15 to 30% off of this high. And as this price moves sideways, this enables a base to form, which helps the stock to act like a springboard. It acts like a springboard to help launch the stock higher into the next move up. And earlier in the beginning of the presentation, you remember we showed you all those stocks that went up 200%, then 70%, then 50%, then 20%. And before each one of those moves, there was a valid base that formed, just like this. Here again is an example of basing action. Okay, we have a multi-month period of basing action. The buy entry is on the breakout above the high of that basing action. And notice how after the breakout, the stock just marches steadily higher. Sometimes the breakout will be a sloping downtrend line. It won't be perfectly horizontal, but still valid. We've got basing action here, and the breakout entry is on the move above the high of this downtrending line. And we have a breakout entry. Now sometimes, what we also teach in our video course is that a valid entry is not only a breakout, but also can be a pullback. If you miss the initial breakout, we look for the first pullback down to support of the moving average. The third step is to have a clearly defined exit strategy. Okay, knowing when to buy a stock is only half the battle. You also have to know when to sell. And we have several rules in place that help us know when to sell. First of all, when the trade goes in our favor, we typically look to sell into strength. If we have a breakout entry, you can sell here for a 10% gain in the strength, or if you're willing to hold through a bit of sideways consolidation, a 15% gain. You hold longer, you get a 20% gain. Obviously, the longer you hold, the more risk there is that the trend will fail, but the longer you hold, the more profit potential. As I mentioned, for swing trading, we typically look to gain about 20% on an average trade. An intermediate term swing trader may actually sit through a short-term pullback like this one and look to capture a bigger gain, but generally we look for about 20%. And obviously not every trade is going to go the right way, so when a stock moves higher but then fails, notice this case right here, we had a breakout entry and then it stalled. In other words, the price action failed to continue higher and it suddenly reversed sharply lower. Remember, when we enter every stock, we automatically have a protective stop price in mind, so that even if the breakout fails to go higher, we know when we're getting out ahead of time. In this case, our stop's is going to be right below the low of the consolidation. So at this point right here, we're out automatically. So our risk is always predefined when we enter each and every trade. Now at this point, what I'm going to do is turn things over to Ed Balog. As I mentioned, Ed is one of the traders at DragonCharts, and Ed is a real trader. He trades, by real trader, I mean he trades real money. We don't just teach this. We trade real money with a small hedge fund, and he teaches people his trading methodology with several newsletters. He's also the co-author of my new book that's coming out soon on trading. And Ed wants to talk to you about his expertise, which is actually the psychology of the market and risk management. So Ed, I'm going to go ahead and turn the presentation over to you now.
As Darren mentioned, one of my areas of expertise has to do with the psychology of trading and managing trades. Now, just a moment ago, Darren spoke about the trading strategy, and really, what a trading strategy is in place for is to and there's rules in place for the way you trade, so you don't fall into the psychological traps or pitfalls of not following the strategy. It's much easier to stay out of trouble with the psychology of trading if you have a particular strategy in place, and because when you have that in place, you follow the rules. Now, that doesn't mean as a human being or as a person that sometimes you don't break the rules, but generally when you're breaking the rules is when you get into problems. That's when you have trouble. So I'm just showing this again because the psychology of trading is all based off of the fact that you have to have a rules-based system. So let's go to my part of the presentation here. So it's critical to have a disciplined money management strategy. And what that means is when you're trading, I can teach anyone technical analysis. That's just part of it. I can say, okay, here's how you identify a trend. Here's what consolidation looks like. Here's where you buy, or here's where you sell. Here's how you buy the breakout. Okay, there's rules for that. If you're going short the market, here's where you sell short to break down. Here's how you use moving averages. Here's how to read a candlestick chart, so on and so forth. That's just half of the equation. That part, believe it or not, is is fairly easy to learn. The hard part is to consistently follow the rules and also have discipline with your money management, because it's the mathematics behind the trade. I call it the mathematics behind the trade. That's what allows you to be a winning or losing trader. Darren had stated earlier that, if you go to our website at Morpheus Trading, we post all of our results for every trade that we do. And on any given, in the course over a course of a year or extended period of time, we might win on 50 to 60, 55 to 60% of the trades that we take on. So our winning percentage isn't extremely high, but no one's is. It's almost impossible to have a winning percentage much higher than that. But what's important is that when you have winning trades, that the potential is there that you're going to make more money on the winning trades than you'll lose on the trades that don't work out. And by approaching it this way, not only are you selecting the correct setups, but you're also cutting your losses in a manner that the losing trades are smaller. Yeah, that's why you have your stop loss in place. And when momentum's in your favor, your winning trades, you're going to make a lot more money than you would lose on a losing trade. So in money management strategy, we say rules to live by, memorize these, right? We never risk more than 2% of the total account value on any one trade. So if you were trading, $50,000, you would never want to risk more than $1,000 on any single one stock trade. Yeah, if you were trading, $100,000, it would be $2,000. $25,000 account would be $500, and so on. It's very difficult mentally, psychologically, to recover from big losses, and we'll see more about that in a minute. When conditions are optimal, we're only going to take a risk of 1 to 2% per trade, and you don't want to be heavy in the market. You don't want to be taking on big size and trying to make make the big money when the market conditions are not in your favor. If you're going to go short the market, then you want the broad market to be in the downtrend. Okay, you don't want to have the broad market going up, being in an uptrend, and you're trying to short the market, and vice versa. If you want to buy stocks, you don't want the market going down and the overall market value falling. If the major indices are falling and you're trying to buy, you're fighting the trend. You're fighting the broad trend of the market, and that's a way to lose a lot of money real quickly, because everyone who starts off trading, they do these things. Everybody, and these are the things that generally you end up blowing up your account. Initially, when you're a new trader, you shouldn't risk more than about 0.5% per trade. So when you're skilled and you have the discipline in place and you've learned the rules and you have the psychology of trading down, then you can begin taking on bigger trades and bigger risk. But initially, if you're trading much more than 0.5% per trade, it's probably a dangerous thing. And by the way, this 0.5% also holds true if you're in the initial stages of a trend reversal. So let's say we were in a long-term downtrend. Then we get a signal, the trend is reversed. We have a buy signal in the market. We have a proprietary model, a market timing model, that tells us when the odds are in our favor that we should be buying stocks, and when the odds are in our favor that we should be selling stocks or going short. So but when you get to the first stages of reversals, so if you were going down for a long time, the trend changes, now you're in an uptrend, we have a buy signal. It's also a time where your maximum trade risk per trade should be lower, and you go with the 0.5%. When you get into the middle part of a trade, the meat of the trade, as Darren called it, that's when, and the trend of the whole market is in your favor. That's when you can take on the bigger size. So that rule kind of holds up whether you're a new trader or depending on what market conditions are. And taking capital exposure more than 10% of the account value on any individual trade. So if you were trading, just to use example, I'm just using these numbers randomly, $100,000 of total capital that you're trading, you don't want to risk more than $10,000 on any individual trade. You don't want to lose more than 10% of your account value. If you do, generally the best thing to do, even if you're trading with the rules, if you have a 10% drawdown to your account, you lose 10% of the value. It's time to stop trading for a little while, back off the market, and reevaluate what's going on. Otherwise, that 10% will become 20, 30% really quickly. By the way, our trading methodology, it doesn't matter what size your account is. I mean, you don't have to have a huge account. You could be trading $5,000 or $50,000 or $1 million. That doesn't matter. What's important is following the rules. And of course, risk control, that's always at the forefront. It's the biggest thing when you're taking on a trade mentally is the first thing you want to know isn't how much money am I going to make? It's how much money can I lose on this trade? Okay, and that's what sets how much you trade, what size position you take, and so on. So you've always got to look at it from the standpoint of this: if this trade doesn't work out, how badly can I get hurt by the trade? And this way, you're taking on trades that give you the best possibility of moving higher, or of not losing more money than what you earn on the trade. Let's put it that way. But it's easy to get caught up in the greed of trading and say, oh, I'm going to make all this money, and not focus at all on how to keep your losses reined in, how to keep the losses tight, so you're not taking too much risk. And this little chart, this just kind of gives you an idea. This graphic, if this was your account, and this is why it matters. In this case, we're saying the amount the stock drops, but we could just as easily be saying if this was the amount that your account dropped. So if you had an account that was, again, I'll use the example, $100,000. If you lose $5,000, you have to earn back. You need to get a return on that money of 5.26% in order to get back to break even. At 10%, you need about 11.1%. Now you get to 20%, you get a 20% drawdown. Now you need a 25% return. You start moving down the chart here. Look what happens when you get to 50%. You have to double your money. You need 100% return to get back to break even. That's very difficult to do. It's particularly difficult if you're going to try to do it in a short period of time. And by the way, what generally tends to happen if you don't have trading rules and you don't follow them, you don't just take 5% hits or whatever. You don't take 10% hits. You take 40, 50, 60% hits. That's what ends up happening. Now you've blown your account up. So then what happens? Oh, I'm down 50%. I have to earn back 100% to get to break even. So then you start taking on more risk. Psychologically, what do people do? What's the average human being going to do? Oh, I got to make this back. I got to make it back. I take on more risk. All of a sudden, no, you're not down 50% anymore. You're down 80% or 70%. Now you've dug a hole so deep, you'll never get out of it. The hole is too deep. Nobody could trade their way back in any reasonable period of time from 80% or 50% or 40% loss. It's just too big of a loss to ever recover from. That's why you have to have the most important thing is defining what you could lose on a given trade and understanding that clearly, because that comes down to the psychology of trading. This all feeds into psychology of trading. Now on this chart, we say we have three primary emotions that drive the markets. There's greed, and of course, when markets are going up, it doesn't matter why they're going up. When a stock's going higher, rationalizing why it's going higher doesn't matter. There's stocks that will go up and they're not even making money yet. The companies aren't even making money, and they won't make money for 2, 3, 4 years. And they keep going higher and higher and higher. Or there's stocks that are making money, but very, very little money, and all the money they make is being reinvested into the company. and their price to earnings ratios will be 50, 100, 200, 1,000. Huge, astronomical price to earnings ratios, and they keep going up and up and up in value. So as an investor, if once the trend starts, you're just the individual. You also have the group, and the group is everybody in the market buying stocks or selling stocks. And when that group starts to buy, you can't get in the way of that, and greed's going to kick in. And as long as people are making money, they're going to continue to buy and buy and buy and buy. But what happens is, as we mentioned earlier, if you don't know when to get out, if you don't have a target, if you're not willing to take profits at some point, then greed can turn into big losses, because there's a next thing that happened. And here we're talking about the state of euphoria, but there's a blinding effect. So one thing I want to mention about the psychology of trading is when you're in the marketplace as a trader, you always are an individual. You've got to be thinking as an individual. Okay, what am I trying to accomplish here? What are my goals? What's the market doing? But you also are part of a group, and it's difficult to fight the group. You can't fight the group, but you have to know when you get to extremes in the market at some point, where do you say, all right, I've made enough money. I'm not going to be blinded. I'm not going to be blind to the greed, because it's easy to just become blinded by greed and not see what's coming. Imagine if I took $1 million in dollar bills and threw them out of an airplane and into the middle of a crowd, and people would be running and greedily grabbing as many as they could. But let's say at the same time I did that, I had 1,000 bulls that started running down the street to trample everybody. And the bulls are running, but everyone's so focused on the greed. Well, as more and more dollars are taken away, and there's fewer and fewer dollars there to make, what's going to happen? Well, some people are going to start to say, okay, I've made enough, and they're going to get off the street and go to spend their money. But there's going to be people who are so greedy they want to get every last dollar, and all of a sudden the bulls come down the street and just trample over everyone. So that's the psychology behind what can happen in markets. Fear is probably the most powerful emotion in trading. And I'll give you a great example. From 1982 until 2007, in the U.S. markets, for example, the Dow Jones Industrial Average went from trading around 500 to 1,000, all the way up to 14,200 at its height. So that's about a 1,500% return, but it took 25 years for that to happen. From the top of the market in 1987, we went from the top of the market of around 14,200 and to the bottom of the market in 2008. So in about 18 months, it took roughly, the market value got chopped more than half. It went down 60%. So 25 years for a market to rally, and within a little over a year, it lost 60% of its value. That's the power of greed. I always say that people don't jump off of buildings because they're making too much money. But when people lose a lot of money, they commit suicide. They'll jump off buildings. There's known cases of it. So greed is extremely powerful, and when it kicks in, you've got to get out of the way. The market's going to fall, and it's going to happen quickly. Now, here, one interesting fact is that fear is a reason to keep. Fear also keeps markets trending higher. And you might say, well, how can that be? Well, it depends on the level of the fear, how much the fear is. If the fear is, there's always got to be doubters in the market. There's always got to be people that are saying, no, I'm afraid to buy anymore here. It's not going to go any higher. Yeah, the economic conditions are that good in a given situation. It can't go any higher. And so what happens is you get people that are trying to short the market. They want to sell short instead of buy. They want to sell short to make money. And when they start to come into the market, when they're trying to guess when the trend's going to change, then what happens is they want to go short. They're afraid the market's going to fall. A lot of people get short the market, and then it goes up again. And all those people that were short selling, they have to buy back the stocks. They have to buy to cover the position. When you sell short, you borrow the stock from your broker, okay, and you sell it at the higher price in the hopes that you can buy it back later at a lower price, and then you make the difference. So if you sold it at $100, you buy it back at $30, you made $70 a share. Well, when you get a lot of people in the market that are fearful that things are going to turn and they start going short the market, guess what happens when it doesn't turn? All those people start to lose money when the market goes up. They cover their short positions. So fear is an interesting emotion on both sides of the market. Fear leads to panic. I mean, you can't say enough about that. When someone yells fire in a crowded movie theater, and the fire flames are going everywhere, people rush for the exits, and many times more people die because they get trampled to death than from getting burned by the fire or smoke inhalation. But that's what fear does. Now, the third emotion, hope, is a situation, and I think it's of these three, it's the most dangerous of the three because it makes you indecisive. You have indecision. You don't follow the rules when you have hope. You were in a stock and it was going higher. All of a sudden it turns around, but it's been in an uptrend for a long time. It turns around and it goes below your stop, your whatever your stop loss was. But you say to yourself, it's not a big deal. This has been a strong stock for a long time. It's going to be okay. It'll bounce. And then what happens is, okay, it bounces a little bit, but it doesn't go back above your stop. Then it sells off again, and you say, yeah, but you know what? This has been in an uptrend for 3 years now. This is no big deal. This is just a little pullback. Okay, well now it's below your stop, but now it's even lower. And then it bounces, and you're like, oh, okay, I'm making my money back, but I'm not to break even quite yet. I'm getting there. If it just goes up a little more, if it gets to break even, I'll get out. Goes up, it never gets to break even, sells off again. That's what hope does. Hope keeps you in losing trades way beyond when you should have gotten out of them. That's why you have to have the trading rule, and that's why you have to follow the rule. When a stop loss is hit, you got to get out. It's just human nature to analyze and try to figure out reasons that fit your decision making. Instead of just following the rules, it's a lot easier to rationalize and say, well, you know what, this or that, and that was just a news story that made that happen, or this or that. Oh, their earnings are really good. If their earnings are really good, it's going to come back. Well, here's the reality. It doesn't matter what your earnings are. If the stock's going down in value, who cares? It doesn't matter how well a company is doing. If the crowd, if the group, people in the market decide that they don't want to own that stock anymore, it doesn't matter. It doesn't matter. There doesn't have to be anything wrong with the company. They don't want to own it anymore. It's going down in value. And then what you're doing is you're sitting there rationalizing why that's happening and why it's stupid. And what it's you hear a common saying or phrase in markets that markets irrational. Okay, or irrational exuberance. Well, I have a saying that in the stock market, there's no such thing as rational or irrational. The market just is what it is. It's just moving in a given direction. The minute you start trying to label the market as rational or irrational, then you're getting into that hope mode, that you hope you're right. In the meantime, the market's going to move whatever direction it's going to move. Markets are not rational or irrational. People are rational or irrational. Individuals are. The market is always right. You cannot fight the crowd. There's one other emotion that I think it's never really mentioned anywhere. This is one that I've kind of added, and I'm going to expand upon this in our new book, Darren, the book I'm co-authoring with Darren. But the fourth one I would put in here is regret. And regret is when excuse me, when you missed a trade, a stock was formed a base, it broke out to a new high, and you regret that you didn't make money on that trade. You know you should have bought it. You didn't follow the trading rules. Instead of buying it when it triggered, you didn't do it. Now it ran $10. The stock was trading at $30, and now it's at $40, and you regret the fact that all that money you could have made. So then what happens? You make a rational, a bad decision. Say, oh, you know what? I want to make some money on this stock. It's gonna go higher. So the stock pulls back $1. Now you don't have any legitimate trade entry. Nothing is set up. You don't have the rules that we have in place for when do you buy. Okay, you you say, you know what? It's pulled back a little bit here. It's been going high. I'm gonna buy it here because. But why are you doing it? Not because of the rules, not because you use your trading rules. You're buying it because you regret that you missed that $10 move. Well, now all of a sudden, it pulled back $1 and it goes up 30 cents the next day. So now you're 30 cents in the money. The next day it drops $2 and now you're behind. You're down $1.70 on the trade. Okay. Well, then you think, I'll just double down. I'll buy more here because it's going to go up. But I regret. So now you got the hope thing going on, but you also have that regret that's driving it. I regret that I didn't make money on that $10 move. So I'm going to buy more here. And then guess what? The next day it drops another $2. Well, maybe then you don't add any more, but you can't take the pain any longer. You're beaten up so bad, you're so far down in the trade. So what do? You say, I give up, and you sell, you get out of the stock, you sell it there, and then 2 days later, the stock turns around and goes up $4. That's what regret does to you. Regret puts you in hope mode. Then when you get into hope mode, you get hit by fear because it ends up dropping more than you thought it would. And then when you get by fear, you panic and get out of the trade, and then it reverses. And then you have more regret. And you say, why didn't I just stay in? Well, no, the question is, why didn't you just stay in the trade? The question is, why did you ever get in the trade in the first place? You should have never been in the trade. It was your poor trading decision that created the regret, that led to hope, that led to fear, that got you out of the trade. And then the cycle continues. Then it reverses, and now you have regret again. So to me, regret is an extremely powerful emotion, and you have to avoid it. If you miss a trade, you miss a trade. Big deal. Move on. There's thousands of stocks in the market. There isn't just one trade. There's many, many trades. You just have to move on. That pretty much wraps up what I wanted to say, but I can't stress enough that it isn't good enough just to know how to pick out stocks that look like they're good stocks. You have to understand the trading rules and stick to those rules. And you have to understand the money management, the numbers behind trading. Okay, how to manage risk is what it comes down to. And finally, you better understand psychology, because this is where most people turn to learn about how to really trade after they've blown up their account. They'll spend all their time and energy learning everything else, and they have no understanding of the psychology behind markets, the psychology behind group, the individual psychology, and they think they have all the rules down and everything, and they blow up anyway. And this is why most traders are not successful. That wraps up what I had to say here today. But it's taken me over a decade to accumulate the knowledge and information I've accumulated to consistently make money, to not not blow up the account, not get myself into a situation where I'm losing a lot of money in an account, that I'm actually making money consistently. And that's not something that you're just going to learn by coming to an occasional webinar, or you just you pick it up from talking to a friend or whatever. At the end of the day, you've got to decide that you're going to pick a strategy that you're going to trade, and then you're going to go with that strategy, and you're going to learn from people that know what they're doing, and you're going to develop that strategy and philosophy, And that's when you become a great trader. You can't become a great trader from just jumping all around. I read this book and then I read this book. Oh, and then I'm going to go to this free webinar and I'm going to go to that free. You'll never become a great trader doing that. And I'm going to tell you why. Because when you go in the market to trade, I want you to remember this. It's a zero-sum game. What does that mean? I mean, somebody wins and somebody loses. Somebody bought that stock and somebody sold that stock short. Well, one of the two people are going to win, not both of them. And when you're in the market trading, you're not just trading, against you or somebody. You're trading against guys like me that have been doing this for a long time, that have all the discipline and rules in place, that understand when to go after it and take on bigger size and go after the big gains, that also know when to stay out of the way. They know when to get short, when not to get short. You're trading against people who have a lot more experience than you do, and a lot more wherewithal, and a lot more money to trade with. So it's not the situation you want to be in. You want to be learning from the best. You don't want to be trying to fight the best, because they will win. Anyway, that wraps it up, Darren.
Okay, great. Thank you very much, Ed. Some great information and insight there. I mean, some words of wisdom there from Ed that come from years of experience. And I think Ed made a very valid point, and that is that, this webinar is designed to give you an overview of what we do. But this is the combination of 10 years of experience in the markets with real money. We've been there. We've been in the trenches. And this is what we do for a living. We wanted to show you an overview of what we do, but some of you I see here in the webinar are already members of ours, and that's great. If you're already a member, then you've probably already watched our video course, our trading course, and you've been receiving videos every day, which continually teach our strategy. And of course, you have access to the stock scanner, which is designed to work with our strategy. But for those of you who are not yet members, if you really are serious about trading and becoming a consistently profitable trader in the markets, what I recommend you do is go to DragonCharts.com. You can see the website right here, and there's a couple different options here. One is you can go to the menu that says Learn to Trade, and you go down and select Stock Trading Success Course. And what you'll see is here a complete summary of our actual trading course. And there's actually 7 modules to it, 7.5, I should say. And it teaches you everything from when to buy, when to sell, goes over more detail, money management, psychology of trading. This is a professional level course, on the same quality as what you get like in a college, in a university, backed by years and years of experience. This course is normally $395 by itself. We also have a better deal, which most of our clients go with, and that's called our Diamond. On the homepage, you just click on this button that says Buy Now, and you'll see the Diamond membership. Most of our members go with this. The reason is because it includes our course, which is $395, but it also gives you lifetime access to our stock screener, okay, and including all future updates. You've probably seen demonstrations of how the stock screener works. It's designed to go hand in hand with our trading strategy, and includes all your updates, and also gives you access to our daily videos. We currently do videos every day for the U.S. stock market, and once a week we do for some of the other markets. And these videos continually teach and reinforce our strategy. And this is $895. Now, to buy the Diamond membership, just click this button, and it asks you for the information. If you have a promotional code, you put it in there. Same with the trading course here. And with the trading course, you would simply select Learn to Trade, the course, and then again click the button and enter your information. You may also be interested in MorpheusTrading.com, which you can see here, the website. This is my company that I started about 10 years ago in the U.S. to teach traders and teach our methodology. Now, Morpheus, to compare Morpheus and DragonCharts, DragonCharts is more for traders that really want to learn how to trade on their own. We teach the methodology through our course and our videos, and then we give you the tools, which is the software to do it yourself. Now, if you don't want to do it yourself, if you just want us to do it for you, in other words, give you our best trade ideas and tell you when to buy and when to sell and just follow that, then Morpheus is designed for you, because at Morpheus we have several newsletters where we do just that. We give you our exact entry and exit points, where we buy the stock, where we sell them. Currently, we cover just the U.S. markets with Morpheus, and you can get a free trial to our newsletters by clicking on this button here, free 1-month trial. Or if you want to skip the trial, or you've already had a trial, you can click on services right here, and you'll get a summary of all of our membership options and our packages that we have. So that concludes today's webinar.